Welcome back. We're taking a look at an alternate version of exercise 9-4 from page 427 of chapter 9, reporting and analyzing current liabilities. This problem is going to take a look at interest-bearing notes payable with year-end adjustments. So we have the company Keisha Company. They borrowed $120,000 of cash on November the 1st, 2016. They signed a 90-day 9% note with a face value of $120,000. We're first asked, on what date does this note mature? So let's just put up a short little graph here with a few calendar dates in it. We know the term of the note altogether is 90 days. So they took out the money. It says on November the 1st, 2016. We know there are 30 days in the month of November. Since they took that out on November the 1st, that's not counted. We count 1 day forward. So 1 full day forward from November the 1st to November the 2nd, doing that same math all throughout the month of November means that there were 29 days that the money was outstanding for the month of November. Okay, so that's part of the 90 days. Now we go into the month of December. We know there are 31 days in December, so we can add these two together, and we know that we're still looking for another 30 days. Well, that would happen to be the month of January. So this note would then mature 90 days from November the 1st, which would be what date? January the 30th, 2017, because this was 2016. Okay? It says, the next problem, what is the amount of interest expense recorded on December the 31st, 2016 and January 30th, 2017? And they ask us to use a 360-day calendar year. So we see that they had 60 days of interest that were in 2016 and 30 days of interest that were in 2017, and altogether 90 days of interest. So we did this in chapter 7. We calculated interest expense. Let's go ahead and put a chart up similar to how we did in chapter 7. We're going to calculate interest is going to equal principal times rate times time. PRT is interest. We can first calculate, if we like, what the interest is going to be for the entire 90-day note. And to do that, you simply take the principal or the face value of the note times the interest rate times the number of days that the money would be outstanding over the number of days in the assumed calendar year. So here we have 360, which is typically what's used for business calendar years. So we multiply that across, and that would mean the entire interest for the entire 90-day period would be $2,700. And this is the chart like what we put together back in chapter 7, so hopefully this looks familiar to you. The total interest due through maturity, principal times rate times the time period of 90 days divided by 360 days. So take that amount, and it comes also up to the $2,700. But the problem asks us what? It says, what is the interest that they should record through December? So we need to figure out not what interest is really for the entire 90-day period of the note, do we? No, we need to figure out just for the 60 days that it's outstanding for 2016. So we're just going to do another chart very similar to this, and this time we're going to take the 120,000 times that same 9% interest rate, but look what we're going to do on the time. We're not going to take it for the 90-day period. How many days are we going to have it outstanding in the year of 2016? 60. So it's going to be 60 over 360. And that'll give us total interest of $1,800. Okay, well, for 2017, we've got a couple of options here. If we're confident in our through maturity interest, we can take that minus the interest portion that goes for 2016, when we know, well, the rest would be interest expense for 2017. To prove it, we can do the math as well. Just take 120,000 times 9% times 30 over 360. And why is that 30? Well, because in January, which was 2017, there were only 30 days worth of interest expense. And once we multiply that out, we should come up with 900, the exact same as if we had taken the full interest through maturity less the interest just for 2016. Let's move on to the next part. Part 4 says, prepare the journal entry to record the issuance of the note on November the 1st, 2016. Well, this is pretty straightforward. What accounts were involved when they borrowed the money? Well, they got cash, And what else? They became liable to pay that cash back. So a liability called notes payable is created. So they get cash of $120,000, and a liability called notes payable is created also of $120,000. And remember, liabilities increase with credit entries. Why? Well, because liabilities are on the right-hand side of the balance sheet equation. And right means what in the world of accounting? Right means credit. So to increase liabilities like a notes payable, we would give it a credit entry. Okay, let's move on. The next part B says, 4B says, prepare the journal entry to record the accrual of interest at the end of 2016. Okay, well, we just did the math up here. We know that we need to record the math calculation of $1,800 worth of total interest. Now, this is interest expense, and how do expenses increase, with debits or credits? Well, expenses increase with debits, so we're going to debit some item, some expense account called what? Interest expense. So on December 31st, 2016, debit interest expense for the amount that we calculated above of $1,800. Now, is that interest going to be paid right now, or is it going to be paid later on? Is a liability created for this interest, or is this interest being paid out right now? Well, it says that they signed a 90-day note and it's all due at maturity, so this interest is not actually being paid out yet in cash. Instead, a liability is being created called what? Interest payable. So interest payable of $1,800 has been created as well. Okay? Now let's take a look at the last part, the 4. It says, prepare the journal entry to record the payment of the note at maturity. So on January the 30th, 2017, that liability for the note payable of $120,000, that credit account in that liability called notes payable, we want to make that go away. How do you make a $120,000 credit go away? We're going to debit it for $120,000. We just created on the previous slide interest payable of $1,800. That was a liability as well, so it had a credit balance of $1,800. Well, we want to pay that off too, so how do we make that credit of $1,800 go away? We're going to give interest payable a debit of $1,800. And there's one last thing we also have to do. We need to record what is the interest expense for 2017 as well. So we calculated the interest for 2016 in an earlier slide. We're going to use the exact same accounts, but now do this in 2017 for 2017's interest expense. So let's do that. Interest expense, we're going to debit expenses. All expenses increase with debits. We're going to debit that expense for $900. Okay, so we're going to have a debit for interest expense for $900, a notes payable for $120,000, and the interest payable for $1,800. Now, that's all the debits. What are we going to credit? What's the company going to have to sacrifice to pay these liabilities off? That big C word, cash. They got to pay cash. So what do we do with the cash entry? Do we debit cash or credit cash when cash is being reduced? We're going to credit cash. And how much are we going to credit cash for? $122,700. And with that, we've completed the transactions for exercise 9-4.